Hey everyone, welcome back to Corporate Decoder. Today we're diving into Eagle Point Credit Company's latest update, and I'll tell you, this one's got more layers than an onion, or maybe a CLO, which you'll soon understand. We're looking at their filing from April of 2025, and right off the bat we see they're planning to offer a whole bunch of different types of stock. And by types of stock, I don't mean different companies, I mean the same company but different flavors. We have a lot to unpack. Eagle Point is a closed-end investment fund, meaning they raise money once and then invest it, unlike mutual funds where money constantly flows in and out. They focus on something called CLOs, or collateralized loan obligations. Think of it as a bundle of loans, mostly those below investment grade or what people sometimes call junk. Eagle Point's main goal is high income with a little bit of capital appreciation, meaning the assets they hold should slightly grow in value over time. They are achieving this by investing in lower graded debt, to be more specific, junk debt. The fund is also externally managed. Now, who's in charge of this whole operation? That would be Eagle Point Credit Management, their investment advisor. As of the end of 2024, these guys had over $12 billion under management. That's a lot of responsibility and a lot of money to potentially lose. A key thing to note is that Eagle Point uses leverage, meaning they borrow money to invest even more. They target to operate with leverage in the range of 27.5% to 37.5% to 37.5% of total assets. This can magnify gains, but it also magnifies losses, making it a riskier game. One of the first things that sticks out is their net asset value, or NAV, the market value of everything the fund owns. Their NAV per share at the end of 2025, a loss in value is never good 8 cents, but management estimates it's dropped to between $7.18 and $7.28 by the end of March 2025. A loss in value is never good. They want to make it clear this is a risky play. Investing in our securities involves a high degree of risk, including the risk of a substantial loss of investment. It's there in black and white. Management gets to decide how they use any funds raised in this offering. They don't have a specific plan, and you don't get a say. Risky, risky, risky. Let's talk about something else, voting rights. Preferred stockholders get to vote on some important stuff, including electing 2 of the company's directors, but if they don't get their dividends for 2 whole years, they get to pick more directors. Now, if Eagle Point goes belly up, who gets paid first? It's not the common stockholders. The preferred stockholders get their liquidation preference, essentially $25 a share, plus any unpaid dividends before common stockholders see a dime. They intend to pay these monthly dividends in arrears, but what if they can't? Well, they have to deposit with the redemption and paying agent sufficient funds for the payment of dividends in the form of deposit securities. If they don't, the rate goes up. The distribution plan is key here. They have something called an at-the-market offering. This means they're selling shares over time through a dealer manager, Eagle Point Securities LLC, which is unsurprisingly an affiliate. They get a commission of up to 2% of the gross sales price. I know that annual and semi-annual reports are usually boring and that a lot of people glaze over them, but they do contain a lot of important information that the company would like to point to you. Of course, the offering doesn't come free. All of the selling of these securities, legal fees, and everything else will be about $500,000. To the description of the Series F term preferred stock. Each of these series are a little different. They are all designed to get your money. Series F term preferred stock is like the other preferred stocks. If the company goes under, you as the stockholder are entitled to receive about 25 plus any unpaid dividends that are owed to you. That in any event, if the company goes belly up before you can get paid, your investment is in danger. If things are looking a little scary, debt can be a good option as it will most likely be paid before equity. But with the debt having the following terms, think again. Redemption is the right of the company to get the shares back at any time on or after a specific date. You, the stock owner, have no say in this in a way. They are forcing you to return the shares back. In terms of legal matters, Decat will be looking out for Eagle Point, and Dwayne Morris LLP will be watching out for the placement agents. So what's the story here? Eagle Point is a complex high-risk investment vehicle that's betting on the continued stability of the loan market. Their management team takes a hefty fee and there are plenty of potential conflicts of interest. While they're aiming for high income, the risks are equally high, and that recent drop in NAV is definitely a warning sign. Eagle Point operates in a specialized and perhaps somewhat obscure part of the market. They are not easy to value and require very skilled analysis. And here's my overall takeaway. Eagle Point isn't for the faint of heart. Thanks for watching, and if you found this corporate decoding helpful, please like, comment and subscribe for more.